Hey, welcome back to Two Super Guys Trade Stocks. I'm Dylan.
And I'm Vinny. And today we're going to talk about how inflation reports harkens back to something Michael Burry talked about a while ago and how I was dead wrong about inflation. Dylan was right on this one. We're going to talk about the predictions here in a minute. Get to it.
Two Super Guys Trade Stocks.
So
Could you say that last part again?
Dylan was right.
Okay,
Yeah,
cool.
I
I
also
just I
that
couldn't hear it.
on the record. Do you want me to call your mom or your wife and tell her that either?
No, they
No,
know.
yeah, bad idea. Yeah, I doubt they know. So this week was kind of wild in the market, right? Did you see this like massive cliff sell off here in the
Mm-hmm.
morning?
I was day trading
Yeah,
it. Yeah.
yeah, pretty intense. And then we also got another little blip here on Friday. Did you see like the news stories that kind of drove those and what this harkens back to a little
I
bit?
know that inflation came out a lot hotter than expected, but it recovered fairly fast. In fact, TLT, which is inflation dependent, kind of, that's not
Hmm.
necessarily true, but kind of, dipped, broke its 93 level, which I talked about in another video, and then immediately recovered. So,
Yeah, yeah. The trading around has been kind of interesting, but like my point here that I wanted to illustrate with this video is, harkening back to prior episodes of inflation a little bit and how, it's not a one and done episode sometimes. And like there's a lot of lessons to be learned from that. If you remember Burry talking about this bullwhip effect, that might be a little bit of what we have going on here, where we're starting to see these fasciculations in the interest rate. I'm sorry, interest rate in the inflation rate. That's part of the kind of thought process here is as we're approaching, back to more towards a normal level, it's still get these little kind of like bumps and speed bumps. And that's what we saw this week. We got like a little speed bump in the inflation story, and the market reacted pretty violently to that.
yeah, they definitely do not want, they want the rate cuts. It's not going to come till May or later, in my opinion.
Yeah. So I have the prediction here from the latest CME group in the
Oh,
presentation. We'll be out of
perfect.
here in a second too. Yeah. Um, Now, this is the CPI headline number in case you haven't seen it. This is the overall chart. We have come down, obviously, significantly from where we were as a peak. But we started to see these kind of little flattening out here and these little kind of fasciculations around this level. The core CPI, which is the more problematic, this is headline CPI minus food and energy, which are a little bit more volatile, gets a little bit smoother curve out of this whole thing. It's stabilizing at a higher level than the headline CPI, in part driven by the different kind of components that are included there, right? That was the number that came out on Tuesday, and we had the pretty dramatic sell off. PPI is the one that came out on Friday, all right, and we also had like a not so great opening. In fact, we had our first like negative week for the SPY in what 4 or 5 weeks. It's been a little while. We've been in like a ridiculous upward trend, right?
Yeah, it's just Nvidia and Meta keeping everything afloat. It's such a skewed. You can't even trust the SPY or the Qs as the overall market anymore because there's four companies that are like 20% or more for each, and
Yeah.
they're AI, so it doesn't matter.
It's absolutely astounding. And when we look at this core PPI number, same thing. It's kind of stabilizing a little higher rate than the headline number. So we're seeing it kind of flatten out at a level which is still above target, which is kind of the real struggle here. This is your beloved TLT, Dylan.
Ah,
I mean, look
nice.
at that like ridiculous cliff that it fell off of in the morning on Tuesday,
Yeah.
and then it started to recover by like the end of the week a little bit, but we're still down 1% over the last 5 days.
As long as it
Um,
hovers around this 93 to 95 ish range, with more precisely 91 to 100, I'm golden. Honestly, this sounds odd, but this increase in inflation helps my wheel strategy a lot because the longer we
yeah.
go at with no rate changes, the more money I get to make.
Yeah, yeah, fair enough. The mortgage rates pop up back over 7% as a result of
Great.
this as well, in case
It's
you hadn't seen
crazy.
that.
I did
And
not.
because, right, bonds and interest rates, they kind of have this inverse relationship with each other, bond prices, that is. So, you saw the 10-year Treasury yield pop up. I want to say it hit as high as like 4.2%, whereas, we were below 4% not that long ago. That's why you've seen TLT that went up to like 100 and now has come back down a little bit and cooled off because the 10-year yield rate has come up,
Right.
and that
Makes
drove
sense.
up the mortgage rate.
You can't have housing prices and an interest rate that high. It's just not conducive to the economy.
Yeah. So, you remember when Burry was talking about this? How each inflationary cycle typically had like three peaks. Remember this? This is kind of
Long
what I
time
think
ago. This is a while
this
ago.
little bit of the story here, right? Is that we're seeing, the unfortunate fact is that inflation is not going to resolve in a straight line down. Is that it's going to persist a little bit longer at a higher level than we'd like it to be, and you're going to see a couple of peaks. Hopefully, you said the largest one is well past, but we may see a couple of shorter term peaks on its return back to that 2% target the Federal Reserve has set. This is that CME watch tool. And look at these numbers now. I didn't put a comparison chart in here, but you and I follow this
Yeah.
relatively regularly. So you kind of get a good idea of the ballpark. At one point, they were calling for a decent chance of a rate cut at this March meeting already. Now look at this. They're saying 90% likelihood that it does not get a rate cut in March. And only
Or,
us,
and above 50 that it doesn't get a cut in May. Let's
yeah.
go. All
So
right.
now the market is targeting a June potential first rate cut. And even then
Okay.
it's like not entirely certain.
Yeah, I mean
Yeah.
that's a heads or tails percentage.
So as far as like going forward, what are the things we're looking at, right? We have PCE will be coming out for the month of January, not too distant future. That's Chairman Powell's favorite go-to. He has said that explicitly. In particular, you're looking at the non-housing services sector. That's been like the most resistant one to coming back to reality, and it's largely driven by labor, and it's largely driven by labor and non-construction related entities. The real struggle is going to be what that number looks like, and then what the pattern of that is for the little while here, because Powell has been very, very clear that he's following Paul Volcker's kind of playbook of keeping at it, and he would much rather keep these rates higher than he would think necessary for longer than we would think necessary in order to ensure that we do not get any more peaks of inflation. Because back in the 70s, you're looking at inflation peaks that got higher and higher. So far we've only seen them come a little bit lower. We haven't had another peak that's been anywhere approaching the first one, but hopefully that doesn't happen. So I think the lesson here is that we may be living in this higher interest rate environment for quite a while. I was being a little bit cavalier or misinformed or stupid guy in that I thought they would start to cut rates like maybe March to June of this year, and now like my perception has really swung that we may be looking at high rates throughout the majority of this year at a better minimum. Now they have a dot plot which suggested 75 basis points of cuts during this year, but that's just their expectation, and we saw how wrong they were about their expectations on
Not
the
even close.
increasing rates too. So
I seem to remember that you put your money on a March rate decrease, if I remember correctly. I do have a question regarding these percentages. How many people are voting? Because there's two people that have a serious problem that 1 year from now they think the rates are going to be at 3, which is that's just it's not going to
well,
happen.
no, that's a good point. You might be thinking they might be kind of counting on a recession. That was one thing Burry talked about. I don't remember which slide it was on here, but he was saying like, "Oh, we'll be in a recession by then." So the people that are saying the rate's going to come down significantly are expecting the economy to break. That's not a good come down. It's a bad come down.
Yeah,
So
I
think
mean,
about
you
it that
still
way.
don't want to come down though, because the more inflation we have, the more interest we have, the higher the American government goes into debt, and we're at 34 trillion. It's already becoming a horrible, horrible problem. It already is a horrible problem, but the longer
Yeah.
we're at these interest rates, it's better to just, like Jerome Powell said, stay here for like 8 months and then not have to worry about it. Then you can slowly decrease. If you decrease too fast, you're fucked. It's a
Yep.
problem. Sorry for my
Yeah.
voice, guys.
Yeah, I mean, you end up paying a lot more in the long run from a economic standpoint. I get that, but I think that is the side of the aisle or coin or whatever you want to say that Powell is leaning towards as being much more restrictive
Yeah,
for longer, and particularly the American economy hasn't shown any signs of cracking yet. Right?
we're doing fine.
GDP is still coming in positive numbers. Jobs are still being created on a monthly basis. So he is emboldened to be super aggressive, and rates are not going to go down for a while. That's I have swung my perspective on this.
TLT for the win. All right, let us know what you guys think.
Catch you next one.